Hello everybody, it's Randy Patrick here. Welcome to Housing Bubble 2.0. News of the week, or as I like to call it, another episode of As the Housing Market Turns. So guess what? Today is Saturday. It's the, I believe it's the 21st. If memory serves me well, the days are all merging together right now. Been a very busy few days for me. A lot's going on in the news right now. I need to do some catch up, so we'll hit it right now. Maybe a bit of a longer video today. Next one I'll do will be hopefully a little shorter and more to the point. I get what people are saying out there, but there's lots to talk about, okay? So obviously, where are we with real estate? Well, clearly the coronavirus and how it's impacting housing is first and foremost with respect to what's going on in the news right now. I mean, clearly there's a lot of financial issues, stock market issues, economic issues, job loss issues, health issues. So everything's sort of mounting, everything's kind of snowballing right now. It's what we would call the perfect storm. So when we talk about, black swan events or domino effects, it seems like that's what's happening right now in the marketplace. Let's talk about real estate, see what's going on. So the other day, NAR, which is National Association of Realtors, released their existing home sales report, and this was for February. So I just want to give you a little tag in on this. So basically, February home sales rose 6.5% from January to a seasonally adjusted annual rate of 5.77 million for February. So basically, when they say an annual adjusted rate, they're looking at, they feel that the year 2020 is on target for 5.77 million home sales across the 2020's 12 months. So again, it's up 6.5% in January. That's for the 8th straight month. Overall sales greatly increased. Year over year, up 7.2% from a year ago. So from February last year to where we are in this February with 7.2% year over year increase. All right. Basically, February sales were the strongest since February 2007. So that's, I guess, encouraging. And of course, Lawrence Yun, NAR's chief economist, said, I would attribute that to the incredibly low mortgage rates and the steady release of sizable pent-up housing demand that was built up over recent years. There you go. Median home price for all homes February 2020 was $270,100, up 8% from February of last year. So a decent increase in value per homes that we're selling. And that's all houses across the board. That's single family homes, condos, manufactured homes, the whole enchilada basically there. Lawrence Yun noted that February's home sales were encouraging, but certainly not reflective of the current turmoil in the stock market or the significant hit the economy is expected to take because of the coronavirus and corresponding social quarantine. So yes, this is February numbers. Everything sort of started to hit, and had issues in March. So these are decent numbers. Clearly things are going to change as time goes on. Total housing inventory at the end of February totaled 1.47 million units. That's up 5% from January, but down almost 10% from a year ago. Unsold inventory sits at a 3.1 month supply. At the current sales pace, equals supply recorded in January and down from the 3.6 figure recorded in February 2019. So we really haven't gained any supply with respect to housing from the past couple months, and it's actually down from this time last year. Okay, talk about regions here. So obviously, NAR breaks this down into 4 regions, all right? So the Northeast, existing home sales for February of this year, the Northeast fell 4.1%, and the median price was up 8.2% for a value of $295,400. I will put the link in the information section of the video so you can go right onto NAR's website and take a look at this. This is a general press release. Existing home sales in the Midwest actually increased 0.8%. Not much, and the median price was about $204,000. That's a 7.9% increase from last year. Existing home sales in the South climbed 7.2%, so that's up 8.2% from the same time a year ago. The median price was up to $238,000, 8% increase from a year ago. And I guess you could say the real winner in existing home sales was the West. The West surged to an 18.9% increase from January to February. That's 11.5% increase from a year ago. So both the year over year and the month over month was up big time. The median price is $410,000, up about 8%. So there you go. So when I look at the West, probably again demand, and obviously we would probably see the fact that more people may have put their homes for sale, trying to lower the price, coupled with the low interest rates, probably gave the West a bit of a I guess, uptick and sales stuff there. excuse me again, pollen. I was out today cleaning up the yard and there's green dust everywhere. Okay, please relax. All right, market conditions. So I like to go through what NAR says about market conditions. Okay, first-time home buyers. So as a percentage of sales across the board, first-time home buyers were 32%, which is the same as last year. Sales to investors were 17%, up 1 point from last year. Cash sales, 20% of the deals were cash sales, down from 23% last year. Distressed sales were only 2% of the market, down from 4% last year, so half the distressed sales as a year ago. And typically when we look at the distressed sales, out of that 2% of the overall distressed, usually about a little over 1% is REO, which stands for real estate owned, bank owned properties. So those are homes that have been foreclosed on by the bank, taken back in the bank's inventory, and they've put them out in the MLS for market. So that's what happened there. And then the less than 1% is typically short sales. Again, short sale transactions that closed, typically about 1% or less than 1% of the overall market. So that's the scoop right now. Excuse me. Existing home sales by region: South 44% of the marketplace, West 22%, Midwest 22%, and the North 12%. So we also hear that this time of year seasonality does impact certain locations, especially in the Northeast, where weather apparently is quite a big factor. If it's snowing, if there's snowstorms, blizzard, freezing rain, very like extreme cold, that does have an impact on closings and what's going on in the marketplace. So please keep that in mind. And sales by price range. So really, it's almost split every month now. 38% of the sales were in the 100 to 2K range. 38% of sales were in the 250 to 500K range. If I take a look, it looks like 15% of the sales were $500,000 and above, and 9% of sales were from 0 to 100K. So really that sort of 100 to 500K is where we're seeing the bulk. I basically look at the 100 to 250 as the affordable housing marketplace. So there you go. So some increase for February, but guess what? It's not going to last long, folks. I can tell you that right now. Now, once this is existing home sales released by NAR, we also get to hear about the new home construction in February. And that typically comes out with National Home Builders and the U.S. Census Board. So new home construction slipped in February before the coronavirus even became a major concern in the U.S. So weather had a big impact on housing start activity in recent months, but the COVID-19 outbreak will soon start affecting the U.S. real estate market. So that's the headline and the tagline for this article. The numbers: builders started construction on new homes in the U.S. at a pace of 1.6 million in February. The Commerce Department said this represented a 1.5% decrease from an upwardly revised 1.62 million in January, but that was still 39% higher than this time a year ago. Permitting fell, and I'm trying to take a look here. What happened? Declines in activity surrounding multifamily buildings drove the downturn in both housing starts and building permits. So realize that new home construction has two components: single family starts and multifamily. So if multifamily is a hot sector, that increase in their volume will bring up the overall. So sometimes the statistic can be somewhat misleading, and also this is a number that's revised quite a bit. So it may be a good number this month or not so good. Then the next month we hear the previous month was revised upwards or downwards. So it just depends on what's going on. So big picture here is drivers of home builders. There have been two big drivers for home builder ramped up activity in recent months: interest rates and weather. Home builder confidence has been sky high thanks to low mortgage rates, as they have continued to stoke the demand for housing. The decrease in rates has made it a more affordable position for many Americans to purchase a home, but with few existing homes in the market, they've had to turn to new construction. So we know that people are looking at new construction. That's obviously what's out there. However, again, seasonality and weather does affect the new home construction marketplace. So as I said, colder, poor weather, whatever it is, less people are going out to model homes, going to developments to purchase property. But again, they're looking at 1.6 million pace. So we need 4 to 5 million homes to be built this year. 1.6 million is not going to cut it. It's not going to actually deliver what we actually need to see in the marketplace. So as much as it's helpful, new home builders, and funny, you hear so much conflicting information. Earlier I reported that I guess home builder sentiment was down a few points. So even though home builders confidence is up, Well, but their sentiment is down, so I don't know where this information is coming from. So again, read between the lines. All right, there you go for that. So we've talked about the existing and new home sales. This article says home sales could fall 35% as coronavirus stalls spring housing market, new analysis says. So basically, home sales could fall by as much as 35% annually this spring compared to last quarter, so 2019. According to new analysis by Capital Economics, that would mean total home sales of around 4 million annualized, as opposed to the 5 million and change that we spoke about earlier. Increasingly restrictive measures on people's movement and an imminent surge in unemployment are the key reasons, according to an economist at Capital Economics. Now, when I take a look at this, I certainly agree, and the fact of the matter is you have a decline in consumer confidence. You have basically, people are staying put. There's less foot traffic looking for homes. There's less open houses going on, so people listings are being pulled off the marketplace here. We also have people who are now losing their jobs in record numbers. So the past week we've seen, the New York state unemployment website, crash. The Ohio State website crash. We've seen a bunch of unemployment surge. I think I read today that Goldman Sachs believes that over 2.6 million people have lost their jobs in the matter of the past little while, so a few weeks. So that's a staggering number. People, if they're losing their jobs, what's going to happen is they're going to suffer financial issues, which means they're not going to pay their rent or they're not going to pay their mortgage at some point in time. And that's going to be a domino effect for the marketplace. So we're going to see people who get stuck, and it's going to put stresses on the economy. How that rolls out and affects the housing market, well, I have my thoughts on that, which we'll talk about in a bit. But just, now someone's saying homes could fall 35%. Yeah, that's a decent number. That's just home sales, not values, home sales. But we know if home sales fall, that homeowners who are trying to sell will be dropping their prices because they need to attract more buyers. If this many buyers are dropping off, they need to attract buyers. So I would imagine prices should be moving southwards sometime in the next little bit. All right, interesting to note though, Opendoor and Zillow begin pausing home buyers, citing coronavirus concerns. So Opendoor is an iBuyer, which is an instant buyer. That's what it means. And they're the ones that you can go online and you can type in your address. You're going to get and put some information. You're going to get an instant offer from these type of groups. There's a whole bunch of them out there. But Opendoor basically is saying, well, we'll talk about this here. Opendoor suspends its program nationwide. Zillow shuts down its California buying. So Friday afternoon, Zillow told everybody that it would temporarily stop purchasing homes in California via its iBuying outlet called Zillow Offers. To comply with California's stay-at-home order, we are temporarily pausing purchasing homes through Zillow Offers in the state while the order is in effect. So it's not forever, it's just we're going to respect the state saying it's shut down, all right? Zillow does still plan to operate outside of California at this point in time to serve those in need in buying and selling a home, and are doing so in a way to ensure we're able to accommodate the rapidly changing environment. Opendoor suspended its iBuying platform on Wednesday, citing public safety concerns, and I think that they're saying this is across the country. So they're saying we're just going to hold off on the iBuying right now. So it does make sense. Why would you want to continue to market and put money into your business like this to market to get sales when people are they're not thinking about it? Simple as that. So this will be a test for the iBuyers to see what actually happens in the future. And Redfin also suspended buying on Wednesday. Redfin announced it would be suspending its iBuying program after announcing that its agents are no longer allowed to show open houses in the effort to stop the spread of COVID-19. So you do have companies that are being responsible, which is a good thing. However, it's going to sort of hurt them probably in this marketplace, and we'll see what happens. Now, we know that the iBuyers need to have an appreciating market to work. I mean, I buy your home for X, make some improvements, put in the market for Y, I'm making that little spread in the middle. So it's a capital intensive, we'll call it operation, marketing, sales, acquisition, rehab, sales again. So it certainly is capital intensive, and they're probably saying with so much uncertainty right now, why do we need to spend the money? So that's, again, Redfin, Opendoor, Zillow sort of pulling back. Well, we may see some other ones do that, I would imagine, as well. Okay, this is interesting. So part of this whole virus epidemic is, and we'll talk more about this through future videos as well too, is how it's affecting people. So we've seen lots of unemployment. We've seen closures. Every state and maybe every city has its own dynamic of what's going on. But where I live, bars are closed now. Restaurants, could only be open until 10 o'clock and only at 50% capacity. Now they're just being closed and only allowing takeout or curbside pickup or home delivery of food. So that's going to have an effect on who's running these places. Clearly, what we talk about like a tourist attraction. So we're by the water, we're by Disney, we're by Busch Gardens. So all those places are shut down. Clearwater and that area there, so Pinellas County shut down access to the beaches. So it's effective now. So they're basically saying you can't even go on the beaches anymore. So all these things that tourists are, and this is a big time especially for our state with respect to, it's now like, spring break was this past week for our kids, and I know that a lot of Canadians are coming down, other people from parts of the country are coming down, and they either canceled or they were traveling, and we know people who were in Denver who went to go skiing. They got to Denver, went to Breckenridge, and all the ski hills are closed. So all these things it's a domino effect. So all this is going to do is cause some problems for a lot of people who are employed. That's going to get worse and worse. But we're also seeing things like, for example, Airbnb. So we're talking about Airbnb hosts are beginning to feel the impact of the coronavirus pandemic following a change by the company to its cancellation policy. And what I mean by that is, that's allowed guests traveling over the next month to receive full refunds on their bookings, overriding existing policies put in place by hosts to protect themselves in such situations. That change has already cost Airbnb hosts in California, Florida, Kansas, Utah, Michigan, the state of Washington. These people stand to lose thousands of dollars in reservations. That's sort of what's going on here. We definitely emphasize with guests and know this is out of anyone's control, but this is for our business. Our livelihood just got canceled, saying one Airbnb, I guess you could say owner. Airbnb has built goodwill with hosts since 2008's launch, but the company doesn't do something to help out its hosts, like it risks alienating many of them. And this is where it can create a downward spiral, and this is where people can't recover. Like if we're under lockdown and no travel, and the airlines, like all these industries are getting hurt big time financially, it's going to be a bit of a mess out there. And I know with Airbnb, it looks like you got income. A lot of people are using Airbnb as income in their homes to support living and support paying their own mortgage. If that income is not there, what's going to happen now to those people? I know that some people own Airbnb homes with with renting, short-term rental, and that's what they're doing. So of course that income may have to pay for a mortgage for that. So that income's not coming in. What's going to happen there? Another domino. Will people default because they're just not getting the numbers, not getting the revenue coming in? We're self-quarantining, or we're staying in place type of thing. You're not traveling. This is hurting people big time. Interesting to note too, Airbnb was supposed to do a public offering back in the fall, and that got postponed. If you remember, there's this company called WeWork, and they were highly overvalued, and they were going to go public, and it all kind of fell through when it was realized that not all the numbers were exactly as stated. All the issues, I'm not going to get into it. I don't know that much about it, but again, it didn't go well. All right. Now, so Airbnb postponed their IPO until 2020, and I'm kind of going, well, if they postponed it in 2019 because they didn't want to get hit with the bad sort of reputation and kind of optics that WeWork did, now they're in a situation where, okay, well, all of our hosts are going to be showing losses. We're going to have losses of revenue. Who knows how long it's going to take to get those bookings back up. And if you're a host, and you can't support this anymore, are you going to fall off? So Airbnb is going to have some issues with respect to its revenue base, its host base, and clearly their future IPO will be impacted by this. But again, that's what you do in the marketplace. So whether it's this is an opportunity to make income, or whether this is, if you're using Airbnb to make ends meet, you're going to have some situations going on here. All right. Talk a little bit more about this and how this is permeating across the country. I have three headlines here. I'm not going to go deep into it, but I just want to talk about it. So coronavirus sends shockwaves through Houston real estate. Well, yeah, and what goes down on Houston? Oil and gas. It's one of the biggest oil and gas centers in North America, and a huge port there. A lot of the oil and gas companies are headquartered there, etc. So you've got tons of commercial office space. You've got tons of people that work for that industry that live in Houston. So again, with coronavirus being a problem and oil and gas also dropping big time in prices. I mean, I gassed up today at $1.79 a gallon, and that's a nice low number. Hasn't been that low anywhere near that for quite some time. And they're talking about the oil barrel price, the prices per barrel of oil being getting lower and lower. I mean, that's going to hurt that marketplace. So this is where sometimes you have a double whammy. So in Houston's case, you have a region that is had experienced a hurricane a couple years ago and some flooding. So they're still coming out of that and still dealing with some of the aftermath of that situation. Now you're going to have oil and gas dropping price plus the coronavirus. Not a good time in Houston, I can see economic wise, and that's probably going to cause more real estate issues as time goes on. All right, when we talk about coronavirus already taking its tolls on urban malls, well, think about this. I mean, we already know that 2018, 2019, each year we saw record number of bankruptcy filings by retailers and corporations, big box stores, whatever, right? All the brick and mortar stuff. So you go to your local malls and you can already see that there's, the storefronts, are, they're closed up. They've got advertising there. They've done their decorations. Our local mall here, they've made, all these empty stores like, a kids play area, a, rest area. They've added, I mean, the museum comes and shows some exhibits, or like they're trying to use, trying to be innovative, which is great, but you can just see the foot traffic's not there. And some of your stores like Sears and JCPenney's and whatever, they've gone or are going. So major issues there, which also has a domino effect on the retail sales, which has domino effect on people who work there. So again, that's a problem. And they're basically saying that, the malls are taking a big hit now because they're closed, right? So you can't go shopping anymore because we don't have the that social interaction. So malls and stores that were already hurting are going to hurt even more with this situation. This was news, interesting news. You got to think about this. Coronavirus upends senior housing business, setting shares reeling. Now, of course, this is from a perspective of REITs, real estate investment trusts. A lot of the REITs that are out there, some of them invest in assisted living facilities, old age homes, stuff like that. And of course, when you move on to your retirement and move on to maybe going to a facility, it's not inexpensive. It's actually quite a lot of money to actually live there, meal plan, food, care of the whole bit. So it's a good money maker for a lot of investors. So so these basically are starting to take a hit right now because number one, you're not going to have people moving in because they can't afford it. Two, you're going to have people who are there who, I know a lot of these locations are experiencing, certain parts of the country are experiencing, an increase in cases of coronavirus. So that's going to put extra strain on them as well too. So basically, are they going to lose occupancy? Are there going to be some changeover in those locations, which ultimately will mean less income and more money coming in for the facility, which is in turn owned by the real estate investment trust. So we're going to see some movement and probably some loss in that aspect of the real estate business as well too. But it just goes to show how this is changing the fabric of the real estate industry across the country, from our own single family home to renting, to commercial properties, to malls, to Airbnb, to now to assisted living facilities and retirement facilities. So it's certainly widespread. This is a little bit tongue-in-cheek here, but the panicked wealthy are fleeing the coronavirus, but they're driving up rental prices in the Hamptons and the Hudson Valley. Oh my. So, obviously New York City has imposed some very strict controls on, movement in the city, staying put, what's open, what's not. So people are going, I don't need to be here in the city if I can't do anything, so I'm going to hightail it to the Hamptons. Well, as New York imposes strict stay-at-home guidelines, the number of coronavirus cases skyrockets. Wealthy New Yorkers fleeing the city are driving up the price of rentals in the Hamptons and Hudson Valley. Homes that would typically rent for $4,000 a month during the winter and early spring are now going for $18,000 a month for the month of April. Though the wealthy are fleeing the virus and the crowds, they may end up carrying both to the Hamptons and their small communities at the risk of overwhelming those locations' healthcare systems. So I don't know how many people are actually relocating there, but it's interesting to note that, it's kind of like, okay, well, I've got my cash, I'm going to take it out of the city, and we're going to live over here, and how that's just going to sort of move people around. So I just think it's somewhat humorous, the fact that now, hey, if you own a place in the Hamptons and you rent it out, you're taking the opportunity to jack up the prices. Clearly, these people can afford it. One of the things that we're kind of in tune to down here is price gouging. So I haven't really read much about that lately, but for us, it's kind of, and this actually reminds me a little bit of the hurricane season. The reason being, when there's a hurricane approaching, especially where we are, and any coastal locations, you see it coming on the radar. It's coming day by day. It's going 10, 15 miles an hour. It's very slow. And all the models, spaghetti models, and the tracking of the hurricane are coming through. So you're wondering, and it tells you all the 100 places it could land, right? And whether you're in the path or not. So what happens is people start to panic, and they go out and they buy. Well, in this case, they buy water, they buy food, they buy batteries, they buy generators, they buy tarps, they buy plywood, things like that. So this situation reminds me a bit about that, because even though we're not in a natural disaster, so to speak, it's still a pandemic, and people are still hoarding. They're buying, toilet paper, they're buying food products, they're buying disinfectant wipes, water, whatever. So they're doing the same thing. And this is why we see this a lot where we are in Florida, just because it does happen. And again, people are just preparing. A lot of times, the hurricanes don't hit. You've got all this stuff here, and then when you do, you take it back. So you hoard it for yourself, and people return it to the stores. But this time around, which I just think is interesting to note, a lot of the stores here are not accepting returns. They're like, for health and sanitary reasons, if you're buying all this toilet paper and waters, whatever, it's yours. We're not accepting it back, which I think is what they should be doing. But again, just noting some similarities. This is much different, but again, the sort of mindset is still the same. All right. Sort of speaking about mortgages now, refinances. We talked a lot about refinancing because the mortgage rates were very, very low a few weeks ago. They kind of spiked up a little bit. I know that the lenders are now dealing with an influx of people who are looking to refinance their homes because of the great rates, and that's wonderful. They're having a hard time. So a little report came out by Adam Data Solutions. Refinances surged 20% in Q4 2019. So basically, they reported that 1.2 million refinances were secured last quarter, a 20% increase from the prior quarter, and 104% increase from the prior year. So 20% from Q3 and over 100% from the previous year. So that's the highest point of refinances since Q3 2013. So there you go. Basically, it represents about $391 billion in total dollar volume for the quarter, which is up 19% from the prior quarter and up 138% from the previous year. So people are going, I'm taking my equity out, I'm either hoarding the cash, paying my bills, keeping the money for investments, who knows. But again, as I always say, everybody who refis, that's one less home that can possibly be put on the marketplace, because if you refi, you might be tight when you want to sell if there's a bit of shift in property valuations. All right, the locations that saw the greatest number of refinances, originations, basically New York saw 91% annual increase. Los Angeles saw 159% annual increase in refinances. Chicago is about 145%. Dallas rose 90%. Houston rose 32%. And when I take a look at other locations that round out the top 10, we've got Washington area up 180%. Philadelphia area up 94%, Miami, Fort Lauderdale, West Palm up 42%, Atlanta area up 108%, and Boston, Cambridge, Newton, Massachusetts up about 143%. That's your top 10, we'll call it, percentage of increase in refinances across the board. Lots going on there, so people are taking advantage of that. Now again, mentioned last time through that rates actually went up slightly by the lenders, and just because the Fed dropped the rate doesn't mean mortgage rates will tag along with that. And also the lenders who are now overwhelmed with applications actually raised rates as in a way to sort of slow down the number of applications coming in so they can catch up. I know people now, a lot of people who are mortgage loan officers or support people for the lenders, well, they're not working at their offices anymore. They're actually working from home, which is going to put even more stress on doing, processing refinances, whatever. And then, again, at least the refi is not a home purchase, etc. The refi is a lot of really just paper trail, if you think about it. So I'm sure that closings can get done, whatever, but we're just seeing the volume of that hit the marketplace now, and it's a bit difficult for the people involved. But again, this is what goes on. Last for today, single family rents outpacing inflation. I look at this as being kind of the sleeper for the future. if we see people have issues with their homes, there are going to be more people in the rental marketplace. We'll see some rental market shifting going on here. U.S. single-family rents increased 2.9% year over year in January 2020 compared to this time last year, so almost 3%. Increases in rents averaged 3% over the past year, which is more than double the rate of inflation over the same period. So single-family rents are outpacing inflation, all right? So kind of like our housing prices over the past couple of years were outpacing wage growth, now we have rents that are really outpacing inflation. So as far as whether you're a homeowner or a renter, we're getting hit from both ends now, and it seems to be going up. So hopefully in the future we'll see something balance out here. Again, I'm pretty bullish in the fact that we'll start to see some price declines. It's just natural the way things are going. Rents will take a bit to tag along in that because people need to rent. More people, again, there's a lot of relocation going on. We'll talk about this in the next video on how evictions and foreclosures will affect the marketplace a little more in detail. But you see a lot of people who are basically month to month on their rent and month to month on their income, could be in trouble, and that's going to start some rental shifting as well too. So again, this is interesting to note though. The business of buying single-family homes for rent has lost a little steam this year across the United States, as rents aren't rising quite as fast as prices for investment rental properties in the majority of this country. So again, what do people look at? They look at cash flow, they look at asset-based investing. If the stock markets are having a hard time, people like to put their money into tangible items like homes because you can physically see it and there's typically an increase, etc. So you can cash flow if you buy it correctly the whole bit. So what we've seen is that single-family homes now are a little more expensive on the investment side. And that's so we've seen a little slowdown in rent, but you know what? It's going to balance out. It's going to hit again. I mean, we talk to a lot of people. We're getting our hands on a lot more homes, again, off-market homes, and this is where things are at. So if you're looking on Zillow or third-party websites or the MLS Realtor.com, if you're looking for homes that way, you're going to find retail type homes and you're going to pay retail prices. The numbers may not work for you. What we're going to see is a lot more off-market homes coming on now as people, number one, need money, two, maybe some shifting with respect to ownership, and people who maybe don't want to be investors anymore or want to shift, normalize their business and stuff like that. So we are personally here seeing a lot more activity. And as I mentioned, I do have this really kind of cool turnkey investment property structure going on right now. So if you want more information, please send me an email. I'll certainly put in your phone number so I can get in contact with you via text or phone call. And if you'd like to see what's going on in my area, some great investment opportunities are coming up. We're getting more and more every day. And again, all these are off market and they're typically better deals than you're going to find obviously on the local MLS. So just keep that in mind. So having said that, that's it for this video right now. I'll have another one coming very shortly. It's just in summary, we're kind of at this point where we don't know. Well, a lot of it, there's confusion, there's shock. There's a lot of, we don't have information yet because we're only, it's the 21st of March. We're about 3-4 weeks into this coronavirus thing now. So, we're all kind of figuring out where this is going to impact us, how it's going to hurt us from a personal perspective, from a job income perspective, from a home family perspective, from an economy perspective, etc. So, we're going to have to work through all that. I do believe housing will take a hit. There's people will say things to, I guess, assure the public so that it doesn't create more hysteria or more worry and more lack of confidence or that really lack of confidence. Recall this happened in 2007 and 8, and some of the things I hear are being talked about now were talked about back then, and it didn't make a difference, and things that were promised by the lenders and the government never took place, and they couldn't deal with the volume, they couldn't deal with the issues, they were unprepared for it, and people lost their homes, lost a lot of income, lost a lot of money, got displaced, whatever. So I'm not saying it's going to be exactly like that. I think we're going to have some be a little better this time through on a personal level for people, but I do think there's a lot of potential carnage that's going to happen out there, and we'll be talking about that in the next video. So again, thank you for the views, likes, comments. It's busy. I'm out there trying to hustle and fix properties and move properties. So give me a shout if you want to know about the investment strategy stuff. If you're looking for more information on short sale investing, because I'll have a video of that come up soon, because that's going to be a big thing next half of the year here. Short sales will be rising their head again, okay, rising from the ashes basically. So reach out to me about that. All right, and if you're not already a subscriber, please help my channel grow. Click subscribe, bottom right of the corner. Thank you very much. We'll look forward to talking to you shortly.